The last thing you want to hear when you need your auto insurance most is a robot with countless irrelevant menu options. Which is why with USAA Auto Insurance, you'll get great service that is easy and reliable, all at the touch of a button. Get a quote today. Restrictions apply.
Hilton brings you new ways to stay, with experiences that let you capture the glory days. Introducing the Graduate Hotels. Each inspired by local college towns, these stays are always original and never boring. Get in touch with traditions all across the country and enjoy a stay that's a class above the rest. Book at Graduate Hotels with Hilton Honors Points at Hilton.com. It's a win-win. Hilton, for the stay.
Welcome back to The Bull, your personal finance podcast. I've been waiting for this moment for years. On the path that led me to learn a thing or two about finance, I devoured thousands upon thousands of pages, books, articles, academic papers, financial newspapers, blogs, newsletters, not to mention the countless hours spent watching videos and listening to podcasts on the subjects. But some pages are far more important than others. Some books are tipping points in your life. They change the way you see the world. And mine were different before I started reading a particular book, The 4 Pillars of Investing, and they changed by the time I turned the last page. Maybe it's because I read it in the early stages of my journey. First loves, after all, are hard to forget. Together with other giants like Barton Malkiel and Jack Bogle, William Bernstein will always hold a special place in my heart for the huge impact he had on my understanding of investing and personal finance, an understanding that would later have such a profound impact on my entire life. William Bernstein, a former neurologist and one of the first to adopt a scientific approach to objectively explore the best way to invest and to make this knowledge accessible to everyone, has become a global reference point in finance over the last 3 decades. In our conversation, Dr. Bernstein and I talk about the 4 pillars, asset allocation, his undeniable strong suit, his view of the markets, and much more. So, without further ado, here's my chat with one of my personal heroes, Dr. William Bernstein. Enjoy the episode. Dr. Bernstein, welcome to my podcast, The Bull.
Okay, glad to be here, sir.
Thanks for being here. It's a huge honor to have you here with us. We'll go through a lot of stuff about finance and investing today, but before we get it started, I can't help but ask you, how come that a real doctor, a neurologist, decided to give up the medical profession to start researching finance up to becoming one of the leading voices in the personal finance landscape in the US and worldwide?
Well, I didn't completely give it up for a decade or two. I continued to do both, gradually shifted from one to the other, but for a while I did both. And it's very simple. I live in a country that does not have a functioning safety net, a social welfare network like you Europeans do. And so I realized I was going to have to save and invest for my own retirement. And I approached that in a way that I thought any scientist would, which is that I read the peer-reviewed literature, the basic textbooks, I collected data, I built models. And after I got done doing this, and this is now about 30 years ago, I realized that I had something that was of value to small investors. And about that time, the internet came to the world. The internet had been around for 20 years before that, but easy to use web browsers didn't come in until the early 1990s. And so I put my work up on the web, and pretty soon I'm getting contacted by journalists and other investors, and I started writing books and managing money.
Interesting. Do you think your evidence-based approach gave you some kind of competitive advantage in figuring out all this stuff about finance and investing?
Well, it's not like I was the first person who began to use evidence-based techniques to study finance. That had been going on for, decades before that, starting with people like Benjamin Graham, and then to more distinguished academics, people like, Gene Fama, Ken French, Bob Schiller, and all the other people who began collecting data and building their own models. I really was more of someone who reported on their work rather than did a lot of original work myself. Although I did invent a few very small widgets, but nothing of any real consequence. What I really did was write books about other people's work.
Yeah, but outside of academia, you were maybe one of the first to put together all the good stuff, and it's relevant to allow the layman to understand how to take care of their own money with a rigorous approach. And I think this is highly consequential.
Yeah, well, thank you very much. I mean, the other person who did that much better and with much more consequence than me was the late John C. Bogle, who founded the Vanguard Group. We were looking at somewhat different work, but his work affected many millions of people and eventually wound up managing a large chunk of the U.S. security and foreign securities markets.
Totally.
I'm just one of his disciples.
Yeah, we're all disciples of Jack Bogle, at least here in this podcast, because we all love the passive investing revolution. Actually, we don't like the word passive, but what he did was amazing for at least 3 generations up until now. Now, I'm pretty sure you have heard this question several times, but if I had here, I don't know, let's say Bob Dylan, I would ask him to sing Blowing in the Wind. So I can't help but ask you about the 4 pillars of investing, which is a masterpiece in the personal finance literature. Can you please walk us through the 4 pillars and why they matter so much, in your opinion?
You must have seen the most recent Bob Dylan biopic. I mean, that was the Blowing in the Wind was the joke that ran through that entire movie for those who haven't seen it. Because he was constantly being asked to see it and sing it, and he grew to hate the song. But I don't hate this. This is fun for me to talk about.
No, totally made up as well.
My basic concept of investing is that it's a serious activity. And I start with noting that doctors are notoriously bad investors. And the reason why doctors are such bad investors is primarily because they don't treat it as the serious science and profession that it is. And just as you wouldn't practice medicine without understanding the very basic sciences in back of it. So that's, anatomy, physiology, pharmacology, and pathology. So too, you shouldn't do finance at all without understanding the 4 basic sciences of finance. And those are the theory of finance, okay? And then there's the history of finance, and then there's the psychology of finance, and finally there's the business of finance. And unless you understand all 4 of those, you're going to wind up having your head handed to you. And so trying to do finance without understanding those 4 subjects is kind of like trying to do brain surgery by reading your local newspaper.
Cool. I always read in your interviews that you consider behavior, the psychology side, I mean, the 3rd pillar, maybe the most important one for the long-term success of the investor. Is that right?
Well, I suppose it's extremely important. If I were to ask which is actually the most important, I might say the history. But they're the 4 legs of a stool. Okay, you can't. The stool isn't stable unless you have all 4 legs. The reason why the psychology is so important is because the biggest enemy you have as an investor, that the investor has, is the face staring back at you in the mirror. If you simply maintain an even asset allocation and you invest passively, you're going to beat 95% of professional money managers on a risk-adjusted basis. What's going to prevent you from doing that is the psychology. And what I like to say is that competent investing is simple, but it's not easy in the same way that losing weight is simple. All you have to do is exercise more and eat less. but it's not easy to do. And the thing that makes finance so hard to do, in the same way that losing weight is hard, is the psychology of finance. We did not evolve as human beings to invest with a 50-year time horizon.
Sure. Let me ask this naive question, but it's relevant today given the period we're all living in. I perfectly know the entire history of the S&P 500, and I know anything that happened in the past. But now we have lived, let's say, the craziest April of the last decade, with the tariffs madness and the stock market, which went bananas for a couple of days, then recovered, then went down again, and then again up, and so on and so forth. And the idea of many investors today is, okay, but this time maybe is really different because of Trump, because of the hardest trade war in a century, etc., etc. Therefore, history is not relevant any longer, they might think, because this time is different. How can we overcome this distortion in our short-term perspective?
Well, this time certainly is different, but almost every other time, every other crisis in the market is different too. 9/11 was different. COVID, at least as far as the market goes, was different. And the housing market in the United States was different, unless you knew something about maybe the housing market in Florida during the 1920s, which it resembled. And the essence of financial theory is that you are rewarded not just for bearing risk, you are rewarded for bearing uncertainty. And the greater the uncertainty, the more the prices will fall and the higher that future returns are going to be. So paradoxically, the best times to invest are when things are most uncertain, when things look different and stranger than they've ever looked before. You are rewarded for bearing that uncertainty. Okay. And the very worst time to invest is when things seem perfectly clear and the sky is blue. That's when the returns are the lowest. Think about, for example, how things looked in, late 1990s or the early in the year 2000. It was wonderful. The internet changed everything. We were all going to get fabulously rich. Well, that was an awful time to start plowing money into the market, at least in the short term.
Can you please elaborate on the difference between risk and uncertainty? Because there is a lot of misconception about the difference between the two.
Risk is rolling dice and knowing exactly what the odds are. Okay, if I roll 2 dice, I know that the odds are 1 to 36, that I'm going to roll a 2 or a 12. Okay, if that's what your bad result is. So that's risk. You know exactly what marbles you're drawing out of the bag, or how many marbles are in the bag. Uncertainty is when you don't even know what the odds are. Okay, and uncertainty is the fickleness of history and the cruelty of the mistress of history. It's having history throw things at you that have never been seen before. All right, that's uncertainty. It's what Donald Rumsfeld famously called unknown unknowns, and he was merely riffing on which he was very cleverly riffing on a more obscure concept from Frank Knight at the University of Chicago, which is this concept of uncertainty versus risk. Okay, risk is a known unknown. Uncertainty is an unknown unknown.
Cool. And it's something that we cannot measure with standard deviation or other fancy stuff that finance uses to cope with the, let's say, uncertain side of investing.
Exactly. You can't measure uncertainty with standard deviation. The thing that the phrase a lot of people like to use is black swans. Okay, black swans epitomize uncertainty. And what I like to say about black swans is that the only black swans is the history you haven't read. So, for example, I said that 9/11 was a unique event. Well, if you go back 2,000 years in history, there was another mass terrorist event in ancient Greece caused by a slave revolt of the Greeks against the Romans, in which 100,000 people died, which was much more cataclysmic than 9/11 was. So, if you go back in history, you can always find something that's pretty similar to what you're dealing with now. And for example, the recent trade ructions that we went through, it's a pretty good, it's a pretty good echo of what happened in the 1930s with the Smoot-Hawley tariffs. And there's been a lot of interest in the Smoot-Hawley tariffs because of that.
Yeah, it's understandable. We had here Eugene Fama some months ago, and we talk a lot about the efficient market hypothesis and the framework built by the Chicago School. One of the foundational ideas is that risk and returns are related, and bearing a risk is what you are compensated for through your returns. On the other hand, behavioral economics says that maybe it's not just risk, but emotions that drive the excess return in the stock market. My feelings is that you are somehow at the intersection of the two ideas. I'd like to have your point of view as to what drives, in your opinion, the returns we are getting from the stock market. Is it the compensation for rational risk-taking or a consequence of some kind of human misbehavior?
So I believe that they're just flip sides of the same coin. Risk is the statistical risk, which is what Professor Fama is talking about, is what you see on a spreadsheet. It's what you see in your brain when you see volatility returns, all right? Whereas fear, which is what you're talking about, is what you feel in your gut, all right? And the way I like to explain it is that you can train for an airplane crash or an emergency in a simulator, in a flight simulator. And that's risk. That's cut and dried risk. But fear is what you feel when you're piloting an airplane during a real emergency. It's what you feel in your gut, and you're going to respond very differently. And one of the problems that I have with people who think that mathematics is the be-all and end-all in finance is they're ignoring their limbic systems. They think they don't have a limbic system, this part of our brain that feels fear, and that has been the downfall of many people in finance. They think they understand the math, but they don't understand the gut fear that people have. By the way, that's certainly not true of Professor Fama. Professor Fama certainly understands the connection between those two and understands that they're really one and the same thing.
My understanding is that, in his opinion, you can only decide what kind of risk you are willing to take, and the returns are the consequence of this decision. For example, on the other side, Richard Thaler or Robert Shiller think that you can somehow spot predictable patterns in the stock market by considering, for example, bubbles in the case of Shiller, or overreactions, as in the case of the famous 1987 Thaler's paper. Do you think you can exploit these, let's call them, emotional inefficiencies?
Yeah, there is now more than a half century of data demonstrating that no one does that, or almost no one does that. And there are two kinds of inefficiencies. There's micro inefficiencies, which is being able to pick stocks. And we know that precious few people are able to do that. Yeah, Warren Buffett can do it. Jim Simons can do that. But, just because Steph Curry can sink three-pointers from 25 feet out time after time doesn't mean you can do it, okay? So there are micro inefficiencies. And as far as macro inefficiencies go, again, there are no data whatsoever that would suggest that anybody can reliably time the market. And I think it's fun to think about bubbles. And the most useful thing you can do when you think you've spotted a bubble is nothing. All right. Basically, and I think you can spot bubbles. The trouble is a high false positive rate. What is a bubble? You can't spot a bubble mathematically. Gene Fama very famously said that the very word bubble drives me nuts. He said that in another interview. I think it was on our National Public Radio with David Kestenbaum as the interviewer. And he's right. There are no reliable patterns that enable you to spot a bubble. But what Professor Schiller would say, and I agree with him, is there are sociological things that you can see with bubbles. And there are a lot of different factors. I can expand on those if you want, but the things that you can spot bubbles with are sociological. But the trouble is it's hard to profit from them because bubbles can go on for far longer than you could ever imagine. And the classic example of that is crypto. Cryptos look like a bubble to most people for the past decade and a half. And yet, here we are at near record prices for Bitcoin.
Yeah, sure. Markets can stay rational longer than you can stay solvent, the old adage.
Yeah, exactly. That's a classic, one of those quotes that gets attributed to somebody famous, in this case Keynes, but Keynes never said it.
Like every quote, almost no one said anything of what she's famous for.
Yeah, well, the key thing to look out for is when something is supposed to have been said by Keynes or Benkin or Mark Twain, it's probably apocryphal. Or Einstein, it's probably apocryphal.
Yeah. Einstein never said that compound interest is the eighth wonder of the world. Mark Twain never said that the history doesn't repeat but rhymes, etc.
Exactly.
The most cited quotes in finance are all liars.
Exactly.
Okay. You research a lot about asset allocation, and there are several lazy portfolios attributed to your research. Remember, you are talking to a European audience, so when we talk about the stock market, we don't really think about the S&P 500, but more broadly, the MCI world or the MCI country world. But beside that, we are very close to the US typical investor because now the US stock market weighs 60 to 70% of the typical stock portfolio here in Italy, in France, in Germany, wherever here in Europe. At this moment, we have high interest rates, inflation heading higher for tariffs, for example, high concentration in the stock market, high valuations for US stocks. Would you please give us your perspective about how one should think about her own portfolio, given the situation we're in? Is the typical 60-40 portfolio still a good one today?
Well, that depends upon your situation and your age and where you're going to be spending your money. Now, let me give you an extreme example. Let's think about someone who has a government pension and maybe a private pension, and that person is a retiree, and that person's pensions and in the United States, his Social Security are adequate to pay his living expenses. Okay, well, that person's investment portfolio is totally irrelevant. Their allocation is totally irrelevant to them because that money doesn't belong to them. They're never going to be spending it. Okay, it belongs to their heirs and it belongs to their charities. Now, let's take one step to the left of that. Let's take somebody who has a burn rate of 2%. So now we have a retiree who is only spending 2% of their portfolio a year. Again, their allocation is totally irrelevant. It doesn't matter whether they're 100% stocks or 100% bonds. They're going to be fine, okay? Because the 2%, their 2% burn rate is going to be completely covered by the dividends on their stocks if they're 100% stocks. Now, they have to have a tolerance for that for 100% stocks, but that allocation is fine. And if they want to be 100% bonds, they're going to be fine too, as long as there's some inflation protection in those bonds. And we'll get to that perhaps later. Now, if you're talking about the relative allocation of U.S. versus non-U.S., the place that every person everywhere in the world should start with is the global stock portfolio, which, as you point out, is now about 60-40 U.S. Non-U.S. Now, if you're an American, that's just fine. Okay, because most of your expenses are going to be in U.S. dollars, and you're dealing with you're swimming in an American economy. But if you're a European, that's different. It may be that 60-40 U.S. non-U.S. is not appropriate. You should probably be overweighting the non-U.S. part of it, and if you're a European, you should probably be overweighting the European part of the portfolio, because that's the economy you're swimming in, and that's the currency you're spending. So if I were a European, I might have 40% of my assets in the U.S., and maybe 40% in Europe, and maybe 20% elsewhere, in Asia or in emerging markets.
Thank you very much for this point of view. Very interesting. This is a great topic, and honestly, one of the things I think through most of the time, because our dilemma is that in the last 15 years, we have had a double tailwind. The US stock market was the super top performer of the world, and the dollar strengthened massively. So we got a double gain by investing massively in the US stock market. While on the other side, the European stock market had lackluster results in the last 15 years. So it's difficult for us to think, okay, now it's time to overweight European stocks and give up the masters of the universe like Apple, Microsoft, Nvidia, and so on and so forth. We should behave somehow contrarian to do this, which is counterintuitive for someone who wants to stick with a passive asset allocation. What do you think about my perspective, which is the typical European perspective, because we are all overinvested in the US?
Yeah, I think, you should take those excess profits you've gotten from investing in U.S. stocks and bank them. This is not likely to continue in the future. It could, but I don't see a lot of downside to a European who wants to underweight the U.S. just for the reasons that I've given you. And then also, non-U.S. stocks are selling at almost half the multiple that U.S. stocks are. Well, if you think about
Totally.
Yeah. So what that means is that in order for things to equilibrate in the long term, U.S. companies are going to have to grow their earnings twice as fast over the long term as European stocks are going to have to justify those valuations. One of the things that financial history tells us is that those kinds of growth expectations rarely pan out in the long run.
Yeah, sure. In the last month, we have a taste of what it means when you invest in a different currency, because the fall of the US dollar against the euros was a huge slam to our portfolios. When the S&P 500 lost 10%, we lost 20% in the same month. So we started thinking about, so that's the problem when you invest in a different currency. We didn't experience this in the last decade because the dollar had a secular trend of gaining strength against all the other currencies around the world, since at least the great financial crisis. So what happened in the last month was kind of an epiphany for all of us.
Yeah, come visit the U.S. Your euros will go a lot farther. Now all you have to do is worry about getting detained by Donald Trump's brown shirts at the border.
Okay, this is going to be a topic for another episode.
You can cut that one out if you want.
No, it's okay. It's okay. We keep it all. Let's talk about bonds. You have two strong convictions. One is generally keep the duration short, and the second is favor inflation-protected securities. Could you explain why?
Okay, well, perhaps you're going to have to help me a little bit here. My understanding is that you Europeans, particularly Italians and Germans, do have inflation-protected government bonds. Am I correct about that? I know the English do.
Yes, you are correct.
Okay, and I believe the French also... I think it's the Germans do have them, but they just stopped issuing them, so there are no new issues. I'm not sure I have that right. So the bottom line is that nominal. It's my philosophy is that extending the duration of nominal bonds, that is non-inflation protected bonds, does not offer nearly enough returns premium to justify their risk. So over the long term, the yield curve in the US has offered maybe at most a % extra yield by going from short or intermediate term out to very long term. Okay, that does not nearly compensate for the risk of the kind of damage that can be done to long-term bonds. Now, between about 1940 and about 1980, interest rates gradually and catastrophically rose, and the real return of the long U.S. Treasury bond was about minus 60%. In the UK, it was closer to minus 65%. So you lost 2/3 of your spending power over 30 years by investing in long bonds. That's something you want to avoid. Now, the allure of long bonds is that during most financial panics, they do extremely well. So they're good ballast in your portfolio. The only trouble is that 1 out of 4 times that's not true, as happened fairly catastrophically in 2022.
Yes, unless the rates go up.
Exactly. In other words, if stocks fall because of a financial panic, then long-term government bonds are a good bet. But if stocks fall because your interest rates are rising, then you've got a big problem. All right. So that's why I don't like long government bonds. Now, the one exception to that are ones that have inflation protection. So in the US, that's TIPS. In the UK, that's linkers. And then, Italians and French people, and I think Germans have government bonds that have inflation protection available as well.
Sure. When it comes to diversification, one typically thinks that stocks and bonds balance each other for the reason you explained. But in fact, when a recession comes along, it's okay. Typically, the bonds compensate in part because the Fed and the other central banks cut rates. But in 2022 and in the 70s, it's a problem if you just have these two asset classes. So, the typical third leg is gold. Do you view gold as a reliable diversifier in a very basic portfolio to avoid this kind of situation when you have both stocks and bonds going down?
Well, there's no question that there are times when physical gold can have that function. The problem with physical gold is that you're buying insurance, and it's very expensive insurance. The long-term return, real return of gold is zero. All right. With bonds, at least you're getting a couple of % of real return most of the time, although that's over the long term. But paying, having to pay for that insurance with a 0% return usually doesn't pencil out. Now, my data and my studies and my simulations suggest that precious metals equity is a better bet than gold is. Now, precious metals equity actually has even lower returns, but the trick than gold does. But the trick is it is so volatile that the rebalancing bonus you get by buying low and selling high more than pays for itself. The trouble with physical gold is that it's not that volatile, whereas precious metals stocks are basically a leveraged bet on gold. And so there have been several times over the past 70 years when precious metals equities have fallen 75% in price, and several times when they've tripled or quadrupled in value. And if you have a very dedicated, very small part of your portfolio, say 1 or 2 or 3 or 4% to precious metals equities, and you religiously rebalance that against the rest of your portfolio, the buy low, sell high discipline of doing that adds about 5% to its internal rate of return and improves overall portfolio performance. The problem with that is it requires a very long-term perspective, and it requires nerves of steel to do that. It requires absolutely, the kind of courage that most investors can't muster to be throwing what seems to be a fair amount of assets into an asset class that has been falling for the past 3 or 4 years. And you buy a position in it, and then 6 months later, you're down another 30%. And then, do you rebalance and add even more? Well, the discipline tells you have to. Most people don't have the courage to do that. So I don't recommend it for most people.
Okay, I see. So would you recommend for the typical investor to just stick with stocks and short bonds, or stock and inflation protected bonds, and stop? That's it?
Yes. The thing that inflation protected bonds are the most useful for is for the retiree. So say you're 65 years old and you expect to live until you're 85 or 90 or 95 years of age if you have good genes. But what you can then do is you can buy a ladder of inflation protected bonds that matures every single year or close to every year. And that guarantees your real consumption in those years. There was a 30-year TIPS bond. If you hold it for 30 years, is absolutely riskless at 30 years. Okay, in terms of your consumption, you know exactly what your consumption is going to be in 30 years. The problem with the 30-year TIPS is that if interest rates rise by 2%, your market value of that portfolio is temporarily fallen by half. So it's riskless, but only in the long term. Whereas Treasury bills are exactly the opposite. Treasury bills are riskless in the long term, in the short term, because you're always going to be able to roll it in 30 days or in 60 days at a higher interest rate if interest rates rise. The real risk with Treasury bills is the long-term risk, because you never know what your reinvestment return is going to be. And it could wind up being very low, as happened between 2010 and 2022.
Yeah, sure. As far as risk is concerned, you often talk about the difference between shallow risk and deep risk. Could you please explain what that means?
Shallow risk is October 19th, 1987, when the U.S. stock market fell by almost a quarter in one single day. That got most people's attention. And that's shallow risk because the market very quickly recovered. And by a few months later, the market had recovered all of that loss. That's shallow risk. It's irrelevant. Over the course of your lifetime, that kind of risk, or the market going up or down 3%, which will get headlines, but in the long term, it doesn't matter to the investor. All right. Deep risk is Japan in 1990. The Japanese stock investor is still well underwater in real terms, from that debacle. Real deep risk is what happened to U.S. bond investors between 1940 and 1980. Okay, that had a real effect on your quality of life and your ability to pay for your consumption over the long term. If you were a retiree, that's deep risk. That's the kind of risk you should be concerned about. Not even October 19th, 1987.
And how can one cope with the deep risk showing up in the future? We can't forecast the deep risk by design, of course. So what is the best strategy to implement, in your opinion?
Well, you have to ask yourself, what are the things that cause deep risk? And the big thing that causes deep risk is inflation, all right, especially hyperinflation. And then there's deflation. That's not important because that's rare, especially in the fiat money era, when central banks can just print money. So prolonged deflation should be very uncommon and is relatively easy for central bankers to fix. There's confiscation, which when your government steals your money from you in the form of increased taxes or outright confiscation. There's not a lot you can do about that unless you're willing to move abroad and try and spirit your assets abroad, which has its own costs. And finally, there's physical destruction. There's war. Okay, and there's not a lot you can do about that, particularly in an era of nuclear weapons. So the thing about deep risk is there's only one that's common and you can actually do something about that's effective, and that's inflation. So how do you protect against inflation? Well, in the long term, stocks are a fairly good hedge against inflation. Not a good short-term hedge, but in the long term, they are, because stocks are a claim on real assets. So if you look at the worst episodes in the history of inflation, the Weimar Republic and what occurred in, say, Israel or Chile, then you see that stocks held their value. During the Weimar hyperinflation of 1920 to 1923, the value of the Reichsmark fell by a factor of 1 trillion. That's trillion with a T. Okay, but the value of stocks during that period of time actually increased in real terms. All right, so that's the first thing you do. There are certain kinds of stocks that do relatively well with inflation. Value stocks do better than growth stocks because value stocks tend to be more highly leveraged than growth stocks. So that fall in their real liabilities goes to their bottom line. So value stocks, both theoretically and empirically, do better. And finally, obviously, commodities producers are going to do better with inflation as well. So that's what you're doing on the bond side, is you have a bit of a value tilt and maybe a little bit of a tilt towards commodity stocks as well. Not a big tilt, but a small tilt towards them. On the bond side, what you do is obvious, which is you stay away from long nominal bonds. If you want to buy long bonds, buy only ones that have inflation protection and have lower yields, of course, because of that, or keep your duration short, less than a year or two.
Great. Thank you so much for this very clever perspective on how to manage our own portfolios. The examples you have just made support the general idea that stocks in the long run are almost riskless investments. The idea obviously was popularized by Professor Jeremy Siegel, although not this trivial way. But a lot of people think that the fact that most of the time stocks do well in the long run means that investing in stocks in the long run bears no risk at all. This is paradoxical because if there is no risk at all in investing in stocks, then there would be no return. And I love this paradox, and I'd love to have your perspective on it, because I want people to understand that investing in stocks means that you have to accept the possibility that the superior return may not show up even in the long run.
Yeah, that is absolutely correct. We have a lot of people have this idea that stocks always have superior return in the long run, and the trouble is that is reinforced by the very happy experience of the United States during the 20th century. There was no 30-year period in the U.S. when stocks had a negative real return, although they had a zero real return for 17 years between 1966 and 1982. But in other countries, and I just gave the example of Japan, it is perfectly possible to have a negative real return throughout almost all of your investing career. So there's no guarantee that stocks are going to have superior returns, real returns in the long run, or even that they'll do better than bonds. And that was true. That was actually true even in the United States during the 19th century. I'm sure you've seen the work of a fellow by the name of Ed McQuarrie, who very nicely
of course I did.
Demonstrated it, that the return series for the 19th century, let out a couple of very minor events, like the disappearance of the Second Bank of the United States, which was a very large part of U.S. market cap in the early 19th century. It just disappeared, and the people who were looking at those records conveniently ignored that fact.
Yeah, I hated that paper because I didn't want it to be true. I wanted to find any mistake because I desperately needed to keep my belief safe that if I invest in stocks in the long run, everything's going to be fine. But eventually I had to admit that we have to take into account that, as he said, stocks are not necessarily a good investment. Sometimes they are, sometimes they aren't. Sometimes yes, sometimes no, as in the title of the paper.
Yeah, I mean, this is an extreme and probably a crude and perhaps an exaggerated analogy. But investing in stocks is like playing Russian roulette at $1 million a pull of the trigger, okay? And what's happened is in the United States, the past 4 or 5 triggers that we've, and of course you're spinning the cylinder each time, so you can't do, it's not a stationary distribution, and so just because in the United States we've spun the barrel 6 or 7 or 8 times and haven't had a bad outcome doesn't mean that risk still isn't there.
Great example and great metaphor. Thank you. Before we part each other, I'd love to conclude this wonderful conversation citing the work that you, Christine Benz, and Jason Zweig, among others, have just delivered in honor of Jonathan Clements. If you like to talk a little about it.
Okay. Well, let me do two things. Let me talk about that, and then I'll talk about what the lessons of the book are, which Jonathan Clements, as many of your listeners may know, is an American financial journalist who is just a delightful guy. He's 61, 62 years old, and he's the healthiest person that any of us knew until he came down with a fatal cancer diagnosis, which has a very, very poor prognosis. And so what we decided to do was Christine and Alan and Jason and I decided to do is to put together a book, which is the best of Jonathan Clements. You can buy it as a Kindle on Amazon. If you're in Europe, it's going to cost a lot of money to get it shipped to you. But you can get the Kindle for about $9 or $10. And it's just his best columns put together. And it's just an incredible amount of wisdom. He was very, very widely read. And there are millions of investors out there who I think worshipped his wisdom and looked forward to his weekly columns. And what were his lessons? Well, the lessons were to the things that we talk about, and you talk about it all the time, I'm sure, which is to invest passively. But he also talked about the meaning of money as well, and what is money for. And I think one of the basic lessons that he had was that if you think that money is there to buy you things, to buy you a better car, to buy you a better house, to have better vacations, you're going to be very disappointed. The real purpose of money is to buy you time and autonomy, and to spend time with the people that you love. If you think that money is there to buy you things, then you're going to very likely to have a miserable life. If you think that money is there to enable you the time to do the things that you like and to be with the people you love, you're going to die happy.
Wow, very profound. I really love whatever Jonathan Clements has ever written. I always read the Humble Dollar newsletter every Saturday morning, which is a summary of all the contents Clements deliver for an entire career. And I'm happy you share the possibility to buy the book, and I highly recommend it because it's full of wisdom for any investor in the world. Dr. Bernstein, thank you so much from the bottom of my heart for your contribution today and for all the invaluable wisdom you have provided us with. Thank you. Thank you so much.
Okay, you're welcome. You have a good one.
Bye-bye.
Okay, bye-bye. You have a good one. Thanks so much.
And that's all, folks. I hope you enjoyed this episode and that this conversation with Dr. Bernstein gave you some valuable insights to better manage your portfolios and, more importantly, to approach your wealth with even greater awareness. A huge thank you to Dr. Bernstein for granting me the honor of this interview. You'll find the link in the episode description to the book he co-authored with Christine Benz and Jason Zweig, dedicated to the great Jonathan Clements. And of course, thank you all for the over 13 million episodes you have listened to and for the incredible consistency with which you support and follow this podcast. As always, I invite you to hit follow and turn on notification on Spotify, Apple Podcasts, or wherever you are listening. And don't forget to leave a 5-star review to help us grow and keep bringing on more legendary guests from the world of finance, always new. That's really all for this episode, and I'll see you next Wednesday for another must-listen edition where we'll dive into one of the topics I get the most questions about, right here, of course, on The Bull, your personal finance podcast.